Hamid.
Thank you, Sama. Good morning, everybody. Hope you're all well. I just want to ask if you can mute your mics unless you're speaking. في شوية feedback. I'm going to be switching from English to Arabic and vice versa. If anybody doesn't understand Arabic, please raise your hand. I'll switch to English completely. You know, it's a very special time that we're going through right now. I'm sure a lot of you are going through financial planning, hardcore versions of financial planning with COVID. I'm going to be covering some very basic best practices that I've learned over the years and that I've kind of helped clients with. زي ما قالت سما I'm managing partner at Sequence Advisory Services. We do corporate finance services, M&A advisory, and currently I'm advising an Endeavor company, actually, Luminous Education, with their kind of new financial strategy and with best practices for financial governance and working capital management. I want this to be as interactive as possible. Trust me, I don't like to sit here and lecture, so please raise your hand. Feel free to interrupt, ask questions. We can dig into specific cases for any of your companies. I wanted to take a quick moment to introduce everybody, but I think we have 35 people on, so it'll eat up most of the session. So if you have any questions, just start with introducing yourself first. Sama, I think we want to share the screen now. Okay. I hope you can all see my screen. The first thing I want to start with is financial reporting, okay? So one of the common mistakes that most financial teams make here in the region, Amman, in most SMEs and growing companies, is they either present the financial data to CEOs using accounting software outputs or using audited financials, okay? And although most of you, I know that there's a mix in the crowd between CEOs, CFOs, and financial controllers, but you know, this is more directed for finance team members. And what I want to say is that although most of your CEOs and executive leadership teams understand financial statements, it's not really their job to dig deep into them and decipher all the numbers and what they mean. So, you know, the first piece of advice I want to give everybody here is try to do your reporting in a way that is consistent with what the business is doing and how it's kind of running as an operation, versus just having, you know, audited financial statements that are too summary or something that's super detailed. And I'll show you guys an example in just a moment. The other, you know, major piece of advice I want to give is try to present your financial data in ratio format as much as possible. So, for example, when I say that, you know, we recorded revenues of 100,000 last month, that means very little compared to when I say we grew our revenues by 12% last month to 100,000. So, you know, try to put as much narrative and as much of a story as you can. And as we all know, use diagrams where possible. I want to give an example, if I can just navigate this moment. Okay. Sorry. Okay. Sorry. All right. Can you all see this? This is an example of an accounting software output. Okay. Sama, can you see if I'm? Okay. Cool. All right. So this here is a standard QuickBooks output sheet, and as you can all see, there's a lot of numbers and there's a lot of words, and there's not much meaningful data here. Unfortunately, this is how most financial teams present their data for small medium-sized companies. They just go to QuickBooks and they say, look, give me an output of my P&L for the past 12 months. Have any of you seen this? Is this something that's common to most people here?
Yeah.
Okay. Okay. So again, this is for me. This doesn't tell me much. Can anyone here see, or can anyone here tell if this is a profitable company, if it's doing well, if it's not doing well? Okay. So this company actually does really well. It's a mock company, obviously. So these are not real numbers from anyone. You know, the point that I'm trying to make here is if you present data in its raw format like this, not many people are gonna find it useful. Instead, I would like to show you something else. So this is a reporting example that is very simple. And what it shows here is it shows a mix of non-financial data, so number of customers, for example, and it mixes it with financial data like revenues. It breaks down each category into an intelligible subcategory that can tell managers what's happening in the business. So in this particular example, it's a company that has you know, customers coming in and they register and they enroll and they pay tuition. So this is obviously a school. And in this example, we can see what this company is making in terms of its different revenue sources. It also breaks down costs in a way that I really like. So, you know, breaks it down in variable costs. So this is your cost of services. So you have your sales and wages, you have, you know, all the other kind of stuff that goes into producing this product in the education sector. And then it breaks down your overheads as well in as much detail as possible, but without going into minute details that might confuse somebody here. It goes on to break down the income statement in a way that, you know, most audits don't, and in ways that most financial people don't, but most managers want to see. So as we see here, we have EBITDA, which is earnings before interest, tax, depreciation, and amortization. And as you head into your kind of you know, kind of cash flow positive regions, and you begin speaking to investors, you'll see more and more reference to this number. Other thing I want to show here is you know, kind of breaking it down in a monthly format. So again, the metrics here look very simple, and they're that for a good reason. We don't want to overcomplicate things, but we don't want to present things that are too simplistic. Always present your revenues in kind of a growth metric, so you can see what the month-on-month, year-on-year changes are, and always use margins for your profits. So we care more about how our margins have been changing as opposed to how much our profit has been growing. If our profit has been growing at the expense of our margin, that's not a fantastic thing. So we want to see pricing pressures, we want to see competitive pressures, and so on. So again, just want to show you something real quick. The way we've done this example P&L is we've done year to date. So since the beginning of the year until today, how much have we done in revenues and new customers, costs, etc. And we've also done LTM, which is last 12 months. And we compare the two. Now, you know, we've also added here something that I think most financial managers do quite well here, from my experience. We've added an end-of-year target, which is generally speaking what management teams sit and discuss at the beginning of the year, and then they just kind of leave in a drawer to collect some dust. But in this particular example, the company had forecasted revenues of 16.5 million, and they like to keep tabs on how much they've achieved from this number with every month that passes using the year-to-date benchmark. So again, make sure that you identify everything in a proper way. Make sure that you note your currencies. I know a lot of you guys run businesses that are across regions, across markets. Always make sure that you don't do the mistake we've done here, and always put your currency. and always show details where needed. So, accompanying the income statement should always be a balance sheet. So we've done this template example, and I'm happy to share that with everybody once this session is over. So I want to kind of stop here and ask if anybody can see something here that they can improve on. So we've left a lot of things here intentionally, and I want to open it up to see how some of you guys do reporting, and if nobody volunteers, I'm going to call at random. I'm looking at you, Salwa. If somebody can tell us how they do reporting and what they think needs to be done for this reporting example to kind of make it more intelligible and more of a story.
Do we raise our hand, or how do you do that?
Just feel free to jump in.
All right. I have a question actually before I weigh in on what you just said. You mentioned something about profit margins versus margins versus net income, and not to make the mistake of one eroding the other. Can you go back to that point and explain it further?
Sure, yeah, sure. The point was actually more about how profitable we are being versus how much we're growing our profitability by. So for example, if in this example, let me use an illustration here. So a lot of managers that I've spoken to refer to profits growing, okay? And profits growing can mean, profitability growing from 1 million to 1.2 million. But it can also mean that the percentage of my profitability divided by my revenues is growing. So that's what a margin is. So if you see here, my EBITDA margin here is 74% in this particular example. I'm making 1.8 million on my EBITDA from revenues of 2.4. When my margin drops here, we have to ask the question why. So I'm making less profits per unit sold, and that really goes to your unit economics. And if you want to have a discussion about that, I'm happy to as well. But basically, I have to ask the question here. Are there pricing pressures? Have my costs gone up? Did my revenues go down and my costs stay the same? What are the questions that I need to ask to figure out why my margins have been depleted? Is that clear? Rashid, tell us which company you're representing, and give us a quick overview of what you're doing.
I am the CEO of a new company called Claremont Healthcare Investment. It's a private shareholding company. What we do is we establish centers inside hospitals where we provide family-centric healthcare in 5 disciplines: family medicine, maternity and delivery, pediatrics, dental, and ophthalmology, اللي هو العيون, or the eye specialty. We work with the hospital to, think of it more like the Uber of a hospital. The hospitals have a lot of assets that are underutilized, so we bring in our full team, and we work in partnership with the hospital, and we maximize or increase utilization of their invested assets. We also work with a group of doctors in subspecialties like العظام, القلب, and so on and so forth. Our clinics, when we schedule them to meet with some of our patients that need their services, and we do that on a low cost for the patient. So a subspecialist, for instance, like cardiologist, their fees would be 12 JDs to the patient. This is a new model. We have done the pilot in September of 2019 at the Royal Hospital, and this year We are scheduled to open 3 new centers. We want to reach a network of 15 centers inside hospitals within the next
Yeah.
4 to 5 years. And we are going to expand then beyond that to have standalone centers across Jordan, reaching about
Amazing.
50 centers across Jordan, inshallah.
Amazing.
So this is what we're doing.
That sounds like you have to do a lot of financial reporting to stay on top of all that stuff.
Oh, no shit. Yeah, we have a lot of that. It's a pain. It's a pain. Yeah.
Yeah. Well, thanks for that intro. Please feel free to jump back in and tell us more about the challenges you're facing on the forecasting side, on the reporting side, and so on.
Sure.
So again, I just want to make the point here once again that aesthetics do matter. So if you present a piece of data, and I don't know if I'm sharing, I don't know if you guys are seeing everything that I'm sharing here, but if you share something like this with a management team, decisions will be made based on very fuzzy data, based on something that's very disorganized, and I think that's likely to flow into bad decision making. Really, managers, investors, and everybody involved in that cycle like to look at stuff that's clear, easy to read, easy to make inferences from. So if there aren't any questions here on reporting, I'll just leave you with a couple of more tips before moving on to forecasting, which I think should take the bulk of the session. The first thing I urge you to do is to set a date. As an executive team, you set a date for your finance team and you say, look, on the 15th of the month, we need the monthly output reports or the financial reports for the month that just finished. So the 15th of the month should be the latest that you receive last month's numbers, okay? I highly, highly, highly recommend that you use a consistent template that you just kind of get used to and you look at, and you kind of iterate on and enhance as the months go by. And I really think that having an irregular reporting cycle is a destroyer of cash flows, a destroyer of working capital tie downs, and is just generally very, very bad practice. So I know that finance teams are generally stretched. They're asked for a lot of things all at once, but I think having a hard date where you just receive your financial numbers is crucial. And the second piece of advice I give is the day after you get your financial statements from your finance team, you go over them with them. You understand every single line, why they changed, how they compare to forecasts, how they compare to same time last year, and so on. So again, financial reporting has to be done periodical and in kind of a regular beat.
Hamid, I have a question, please.
Go ahead.
This is Salwa from Little Thinking Minds. Hamid, how do you compare, what's the best way to compare actual versus budget? So this is budget, right? This is forecast.
Yes, so this is a combination of forecast and actuals. In this particular example, we're doing the white shaded cells or the unshaded cells are the last month that was recorded, and the gray cells are forecasts. And this is how I generally format my
so you delete your budget cells, or you compare, you keep them there? January, February.
Yeah. So in general, we kind of put a marker down. So in general, every 3 months or so, or every significant milestone comes with a new budget, right? So let's say you just signed a contract in Saudi Arabia that you think is going to open up the entire market for you. So your finance team sits there and they work on a new budget that includes the Saudi Arabian market, right? So it's very important that we set this kind of goalpost, and we say, look, the end of year target of 16.5 million was our budget from January, and we compare everything to it. Now, strategically, you might think, look, this budget is outdated now. I mean, this was prior to us entering Saudi, so we need a new one. So really, it's up to you and how you communicate with your team as to which of the budgets is the actual one. So with the company that I'm currently advising, they run a quarterly board meeting, and in every board meeting, they kind of double check if they're using the right budget. In general, management KPIs are set at the beginning of the year to a certain budget, and that kind of sticks. That's not necessarily the best approach, Saraha, because it means that you kind of overachieve sometimes when that happens. So finance teams tend to put a budget in there that they can meet. So it's always important to kind of check with that. The other thing I want to say here is it depends on the seasonality of your business, right? So if you're in education, it makes little sense for you to compare April to April, especially if you're running cohorts that are, let's say, 6 months in length. But it might make sense for you to measure year to date versus last 12 months, for example. It also might make sense for you to say, in April, we've gotten 80% of our budget, whereas last April we got 40% of our budget for the spring semester. So you can define the timelines as your business sees fit.
Thank you.
And I'd like to just add one more point. So when you have your projections sheet, that's one sheet that you usually go back to that has your whole year and what you see forward. How I specifically sometimes do it is have a separate budget sheet that's connected to your projections, where you can basically compare your monthly to the budget that compares it on a separate sheet. However, when you input your actuals, you want to have them in one place in one sheet.
حامد يعطيكم العافية. سؤال, can you share with us more information about the presentation that can be prepared after this report comes out? Like, what's the difference between that presentation and the report when it's presented to the higher management in the company, and what should it have in it?
Okay, so thanks, Hassam. Look, I think, and you might not like this answer, but I really think that every company has a set of reporting tools and a set of reporting, let's say, stacks that's relevant to their business model. So, for example, if you're in a very high volume business, you would really care about margins of profitability and turnover, for example. So you want to see, how many times have I turned over my inventory, and how am I hitting my economies of scale as a result? If you're in a specialty service business, I think kind of characterized by higher margins, I think you would care more about sales growth, for example. So I think on the income statement, any standard report that shows sales growth, cost contributions, and profitability margins should cover your basics. But I think what most finance teams kind of neglect or they keep in the background because they think it's too technical for management teams is the analysis of working capital. So what I mean by working capital here is the current side of your balance sheet. Okay, so receivables, inventory, other current assets, accounts payable, that stuff that really kind of saps your cash. So quick show of hands, how many of you have been in a meeting with your finance team where they say, look, we've been profitable last year, but we have no cash? Just a quick show of hands. Okay, at least a few. The reason this happens is because there isn't much emphasis in your kind of meetings about how much money you have in the market that you haven't collected yet, and therefore when you're going to be collecting it. And the second reason is how much of my costs have I not paid yet, and when am I supposed to pay them? So I think on management reporting side, Sam, I think adding that to your finance team tomorrow would make a massive difference to how these meetings go. Again, that's I hope that partially answers your question at least. The other half of the answer I'd say is speak to your board, ask them what they want to see. So for the board meetings that I'm running for Luminous or with Luminous, not for, we always have an agenda sent out 3 weeks before the board meeting is set. And depending on what's happening in the business, different departments are brought in to present different parts of the current context of the company. So speak to your board about that. But with reporting, with financial reporting, always use the same template, and then cut and paste the charts that are kind of coming out of there into the same report. Just having consistency in looking at things, makes a massive difference in how these conversations go. Cool. Okay. Any other questions before we move on to the next chapter? Okay.
Yeah, I have a question slash comment. The challenges that we face with financial forecasts usually is that there's a detachment between what we forecast and then the end result, and usually it's not because of the model of reporting. It's how to get everybody focused on getting the results that we talked about 6 months prior or something like that. What would be the best platform to discuss something like this, the management aspect, and focusing on objectives and getting things done? I know this is a financial meeting, but I'm also curious about that other side of the softer side of running a business. Can somebody advise or suggest something where we can gain more learnings in that area?
Let me chime in here. Thanks for the question. After I finish, please, if any of the attendees has specific experience on how they were dealing with this issue that Rashid just mentioned, please feel free to chime in and tell us about your own experience. But Rashid, from my experience, so first of all, I think forecasts are there they're more there for planning purposes as opposed to setting very, very hard targets for everybody. And I know that might not be a very popular way of looking at things. And surely there are some segments in the business that require very hard targets, like your sales teams, for example. But in general, in the past 15 years, I've rarely seen forecasts that have actually been, hit 100%, right on the dot. They're more as they should serve more as guidelines. Now, the most important thing about this discussion, I think, is to figure out who owns what part of the targets. So, for example, if I have a product development team and I have a sales team, and I'm missing my targets consistently every month, every quarter, every year, the problem should be somewhere there. We're either not developing the right products, or we have a sales team that's using a subpar strategy or something related to that. So the important thing is the finance meeting should guide other meetings. So it should say, look, we're missing our targets. Let's get the sales team and the product development team together and let's figure out what's happening. So it turns from a financial meeting to a completely non-financial meeting. And it's important to kind of recognize, which team owns which part of your P&L and your balance sheet, and to get them together after that kind of initial roundup. Anybody want to share their experience with that? Anybody has any good anecdotes to share from your own experiences?
Sorry, about what specifically?
Rashid, do you want to clarify?
Sure. Well, I am running a team that is a mix of business and medical people. And unfortunately, overall, the Middle East organizations do not produce a lot of middle and upper management teams or individuals that are very skilled in terms of putting objectives and breaking down the objectives into steps that will actually lead to that objective on time. That's from the business side. Now, on the other hand, the medical staff clueless when it comes to those issues. So I run programs. I started at the beginning of the year, just before the Corona started. I started something called the OKR, Objective and Key Results, to try to bring the organization together and to focus on what matters most and the objectives. And I am running a weekly every Thursday at 10:30. We have a weekly meeting for the top management, where we look at the numbers and we look at our initiatives, and we look at our objectives and are we getting there? And you know what? Believe me, it is like pulling teeth without sedation. بدون بنج يعني. It's really difficult. So numbers and forecasts are done usually. I've seen it in so many organizations in Jordan, at least, and the Middle East, as a matter of fact. They're done by the CEO, a couple other guys, and the financial person. And there's a big detachment between what's been done in that closed room over a 3-4 day workshop and the rest of the organization. And what you want to do is build it with them and have them all speak the same language and have the perseverance to be able to follow up and coach and teach them to all work together in order finally for those numbers that we have put together to start making sense. And then the comparisons will start making sense. As far as the board of directors, my experience has been if 10 are sitting on the board, 3 would be interested in the breakdown on analysis that you have presented to us, Hamid. And 7 of them will be playing with their mobiles, unfortunately, during that time. So it's like they're not invested in the numbers as much. If your team is not invested in the numbers and they are working towards it, I don't think either model of the reporting is going to make much sense. So that's my gloomy picture of the situation. I've seen this in UAE, I've seen this in Saudi Arabia, and definitely in Jordan.
So you're talking about the OKRs on a team level, or are you talking about the board?
No, the OKRs is definitely on the team level. I will not even entertain introducing OKRs to the board of directors.
Oh, I mean, this is, I guess, a specific question, but from our experience, I'll just give you my 2 cents, is that we also adopted the OKRs and we did a kind of an overall training for the team because it's not intuitive necessarily.
No, it's not intuitive. I agree with you.
And then I know of some companies that do, in terms of OKRs, like an anchor OKR rather than having the regular OKR strategy that has like 3 to 5 key results for every objective. They have something called the anchor OKR, which they have their employees focus on one thing and one thing only that they can discuss on a weekly basis. Yeah. But I guess this discussion is specific to companies that use this. So if you want, we can take it offline and share experiences.
I would love that. Yeah.
Thank you. Thanks, guys. That's great. And I think this is a great segue actually to next pro tip I have for you, and it's know who you're presenting for. Okay. So when you're building forecasts or reporting templates that kind of look into the past, you need to understand who you're speaking to, who your audience is, and first of all, you need to identify who you are. Okay, so as a CEO, to your board, what do you want to talk about? Do you want to talk about how well the business is going from a growth perspective, how well you're using your cash, what your plans are for the next year. So it depends. Are we in Q4 talking about next year, or are we in Q1 talking about how we're dealing with COVID-19? So I highly, highly recommend that you understand who you're speaking to and figure out what the narrative that you want to present is. Which brings us to forward-looking financial models. A quick show of hands, how many of you and your companies keep a forward-looking financial model? I see 3, 4. Okay, so not everybody. Okay.
I'm not familiar with the term, actually.
Financial models are basically...
no, the forward-looking part.
Forward-looking means forecasting. So, how many of you keep forecasts for the coming 12 months, coming 3 years? What you expect the business to generate, what you expect the business to kind of have in terms of inflows and outflows, and so on and so forth. I'm sure all of you have had dealings with investors in the past 6 months, and I'm sure that a lot of them ask you for your business plan or your financial model or your forecast or your pro forma. They're all the same kind of euphemism for the same concept. So I want to share with you actually, first let me say, if any of you do not have a forecasting or a financial model that you're happy with, please reach out to either myself or Sana or anybody, and we'll help you build one. It is absolutely imperative that companies in the stage that you're at, I mean, if you're on this call, you need to have a financial model. You need to understand where your business is going to be going for the next 12 months. And it's not purely for communicating with your board or your shareholders. It's for you to understand your business in a better way. We have engineers, we have product designers, we have finance people, we have management executives here on this call. Each of you has a very different strength to the other. And so each of you has a blind spot that the other doesn't have. And I think financial models serve to figure out what these blind spots are. Excuse me. So I want to share an example of a financial model that I'm sure a lot of you have seen. Okay. So this is, courtesy of Sana. Thank you very much for sharing this. This is a financial model that many of you would have seen if you were speaking to investors. And again, this is an empty. This is kind of not filled out, but I just wanted to share with you the format so you understand that regardless of what the numbers are, there's the standard kind of the standard output sheet that most investors and shareholders want to look at. What this model here shows is 1 year of historicals and about 5 or 6 years of forecasted numbers. Again, it breaks things down in very, very simple format. So revenues, cost of goods sold, gross profit, EBITDA, etc., all the way down to net profit. And more importantly, it shows a forecasted balance sheet. What this really implies for me is we're not just looking at sales. Okay, we're looking at how these sales are converting to receivables, how these costs are converting to payables, what I'm spending on capital expenditures. So, just a quick technical point here. When most financial teams focus on the P&L, they leave out very crucial pieces of information apart from working capital. So we've talked about receivables and payables being kind of lost in the mix if you're just looking at your P&L. But you also have 2 other crucial components here that generally are not in your P&L. The first is capital expenditures. So if you're spending on technology, if you're spending on bricks and mortar, if any cost that you capitalize will not appear in your P&L, okay? And in fast-growing companies and in any growth stage company, that component is a critical factor to how fast you grow or how well you do relative to your competitors. Okay, if you're not doing balance sheet forecasting, these will not appear. Okay, that would be a very, very kind of big oversight there. The other critical component that you would be missing if you're just looking at your P&L and not your balance sheet, as presented here, is your long-term loans. So those will not appear on the income statement. The only thing that appears on the income statement regards loans is your interest, okay? A lot of companies that I've advised in the past, amazing growth profile, you know, month-on-month growth, over 100%, et cetera. But they took out a loan for 5 million JBs 2 years ago, and they have a principal payment of 1 million JBs coming up next. Company goes into distress mode, tanks, shareholders start, you know, panicking, and the whole thing is thrown in the washing machine, as they say. So again, looking at your balance sheet is super important, and forecasting it this way is very important. One thing Sama has done here in her model, so the sheet we were currently looking at is just an output sheet, which is, I think, best practice is to have, you know, your kind of outputs in one place that you don't kind of play around with, and any kind of variables that you do want to play with, you do in another sheet. So in this one, it's called monthly input. All the figures that are in blue are things that you can change, and all the empty cells are obviously things you can kind of, you know, input, and, you know, all of her assumptions are tied up together, okay? So if she were to change her COGS margin here, it'll flow down to her kind of gross profit and EBITDA. And the point is here, you want to be as flexible as possible without having to rewire the model every time. And again, this might be the part of the session today where I'm speaking directly to finance teams here, and I'm sure that they all understand what I'm talking about. So again, try not to hard code, no funny business. You know, if the balance sheet is not balancing, don't try to find the blank cell where it kind of all matches. The best thing to do is to get your team together and understand where the problem is happening. Sama, do you want to talk about anything here in particular?
I'd like to add that in the revenue model here, so the reason everything's in black, as I said, everything as Hamid mentioned, everything in black is something that you shouldn't play with. It's basically because what you usually do based on every company, you have a completely different revenue model sheet. So in order to get your numbers easier, to see your customer base, to see your turnover, to see how many transactions you had, depending on what your company does, you should also have a separate sheet just to calculate your different product lines. For example, if you're a retail company and you have 100 different products, you should have your 100 different products on there and saying, based on your previous like historical information, what you'd be expecting the next year coming, either through a growth percentage, either through growth of customers, growth of prices, however it is, whatever you want your variable to be, is how you should build your revenue sheets. And that's something as well I can help with whenever you need. It's that back end of the model that's really important, that even you can break down your expenses through it, you can break down your COGS, and this is basically the monthly input sheet that I usually connect all my back end sheets to. And within this COGS assumption, if you go to within the growth portion, I'd like it to be very flexible, that you can either have it based on growth or you can have it based on margin, because there are some things you see within your company that have a direct association with your revenue. So you want to have that flexibility to be able to adjust based on growth or based on margin.
Yeah, just a quick one here. In general, when you're talking about variable costs, you look at them as, in general, margins, but they can also be grown, you know, so you can kind of target a margin, you know, when you're a small business, and as you grow, your cost structure changes, and so your buying or your purchasing ability changes as well, so you want to be able to adjust those. So I really like that Sama did her forecasts here on a monthly basis on the P&L, because the fact of the matter is, when you're modeling just on an annual level, it's too summary in my experience. Now, if you're speaking to investors, that's completely fine. You can say, look, here's our annual plan, here are the next 5 years. Obviously you're an investor, so you care about your multiples. You're entering at a 10 times multiple. You can exit in 7 years at the same multiple, but our EBITDA would have grown by then, and so on and so forth. But if you're doing an operational model, so a financial model that's used for internal budgeting, planning, troubleshooting, then you want to do things on a monthly basis. In this model, for example, we don't have our balance sheet on a monthly basis. So we're just forecasting our income statement in this way. And I think that's generally fine. Okay, I think in general, if you have this kind of this kind of setup, you can couple it with what most accounting teams here do, which is a direct cash flow method, where they say input, output, ending cash balance. I'm sure a lot of you have seen that. Let me stop here for a second. Anybody have any questions or any comments? Shall we pay more attention to any of these sections? Do you guys want more information here? Okay, so we'll just move along. I want to share with you something that it's kind of a template that I've worked on with my team at Sequence. Okay, so this is a sample of a monthly model that aids in kind of business modeling, forecasting, investor relations, working capital management, the whole 9 yards. I'm obviously very, very proud of this. We developed this technique while we were working for clients who came to us because they wanted to raise money, and then we figured out that actually they wouldn't have to raise money had they been doing their kind of financial forecasting and their financial governance in the proper way. And this is kind of a quest that we've always had in Sequence. We're saying, when is being too general hurting us, and when is being too detailed hurting us as well? So where is that kind of sweet spot? Where I can kind of get full visibility on my cash flows and my performance, and at the same time I have the kind of flexibility to update this and not have it sit there as a static thing that we do once a year. So in this example, I just want to show you some of the best practices that we've been using. Always define your model. When does it start and when does it end? So am I looking forward? Am I looking back? Am I looking for 5 years, or am I looking for 3 years? In this example, we've basically done a business plan for a company that has massive working capital shifts on a month-to-month basis. And as you see here, we start from non-financial metrics. So this is a website. This is a consulting company. This consulting company receives visitors on their website, and then they convert these visitors to paying customers, and they have two basic revenue models. They have a B2C and a B2B model. Okay, and as you'll see here, we'll kind of talk through some of the nuances there. So I just want to point the attention to these bottom tabs here. So as you can see, I'm not starting from a summary sheet like this one. I'm starting from a market sheet. So I'm starting from Jordan. I'm saying, in my Jordanian operation, I'm getting a beginning assumption of 4 million website visitors. Okay, and then I'm applying my kind of let me zoom in here in case you guys are getting older like me. In general, I want to apply my assumptions to as little beginning assumptions as possible. So I'm getting 4 million users a day here, or a month, sorry, and I'm converting those into new users. So I don't want to go through the painful detail here, but I just want to show you that here we've done 1, 2, 3, 4. We've done about 10 let's say funnel assumptions to this kind of top level assumption of website users, and we're kind of seeing our business model flow through that. we finally get to a blended monthly subscription price that these website users are going for, and that's helping us map out what our subscription revenue is. So as you can see here, I have about 28 lines before I get to this number. So for your business, what is this number? Is it just a single line that says revenues, or is it users, churn, renewals, et cetera, et cetera, et cetera? So again, I urge you to think about your business models and to kind of put those goalposts in place as you kind of do your forecasting. And just a quick one here. Every single assumption line we have here is an important metric for the business. So it might not be the North Star for that business, but it's a very, very important one. So if my conversion from free trial is lower than what I had expected it to, then I'm going to have a discussion with my product team. I'm going to have a discussion with my marketing team. I'm going to have a discussion with many different teams whose sole purpose of existence is that metric. Okay. Now again, I'm using a bit of a complex example here. I know that we do have some software businesses here and online businesses here that would kind of relate to what I'm saying. And for some of the more kind of traditional businesses that are not as tech enabled, you can kind of just reduce this example into simpler assumptions. Again, here I have the same flow for my B2B revenues, and then on the cost side it's the same thing. How many of my users are paying via credit card, and what are the associated costs there? Mobile payments, what are the costs there? The entire reason we're doing this is we want to get to unit economics. Okay, we want to understand what does my incremental user cost me, and what does my incremental user bring to me as far as revenues go. If you break things down to this level of detail, you will get your unit economics, and then you can apply all the fancy formulas for LTV and cost of acquisition, and all those metrics that your investors invariably ask you about. So again, here we're breaking things down.
I have a question.
I'm sorry?
Hi, Hamid. How are you? Hamid, you're on mute.
Yeah, I'm sorry. Can you get closer to the mic? We can't hear you very well.
Hi, can you hear me now?
Yes, we can.
Hi, Hamid. It's Lean Rimawi.
Hi, Lean.
I find this very important because the level of detail here is very important. I mean, sometimes we start building a model and then we get we pay a lot of attention to the details, and then we have a very complex, we end up with a very complex model that becomes very difficult to maintain. And then it wires back. So level of detail should be top.
Okay, Lean, I think your voice was cutting, but from what I understood from your question is, how detailed shall we get? Because too much details might inhibit us from updating this model or gaining useful insight from it. Is that correct?
Yes, correct.
Yeah, look, I mean, unfortunately, there isn't, a standard kind of rule here. For your finance teams, I highly recommend that you kind of reinforce the culture that, like many things in your business, it's an iterative process. So we start with a framework, and then we see how it goes. Next month, when we want to update it, is it an impossible task? And is it an impossible task because the wiring is off, or is it because we need more kind of team members to help us do this? And it's a super important question, and I think it is a learning exercise for most people. In my next meeting, my CEO asks me about this metric and it's not there. I should add it next time. I should add the inputs that make me, that allow me to calculate this metric in a much easier way. In general, I really don't like overcomplicating things. I like to start from a very simple place and then to add details and complexity as the meetings go on. Because as you said, the simpler and the cleaner things are, the easier it is to kind of run these meetings and the easier it is to get insights. But a lot of times you miss critical details because it's not fleshed out in a super detailed way. And I know that we've had some experience in that. And so, you know, I want to show you something here actually, which is relevant, I feel. So this is my balance sheet calculation sheet, okay? And this might look super complex and super irrelevant to some, but I think it's actually one of the most important parts of the session. If you want to pay attention to any 5 minutes of the session, these are the 5 minutes, okay? This part of financial modeling is rarely done by any finance team I've ever spoken to, okay? And it is not difficult, but it is very grimy, okay? So your finance team is doing really difficult stuff. They're doing numbers, doing accounting, they're doing bookings, they're doing tax, they're doing audits, they're doing all that stuff. Having a dedicated person for financial forecasting is a big plus. And I know not a lot of you have room in the budget. You know, we're slashing costs right now. It's not the time to kind of hire analysts and have them on the team to just take care of our models. But, you know, the more singular this task is, the better it is in the long run. Okay. So I want to take you here to how we do forecasting on the balance sheet on a monthly basis. So, and again, this is more for the finance people on this call. In many models, you see an assumption for days receivable, for example. So days receivable is a general rule of thumb as to how I collect my money from my sales. So let's say I sell 100,000 JDs in annual sales, and my collection is 90 days. It means that I'm collecting this 100,000 in 90 days from the day I sell it. Now, that's a very nice and fluffy assumption to make when we're modeling because it makes our lives easier. But it's actually a very impractical one because anybody here running operations or CEOs or sales teams, you all know that when you specify in the contract 90 days, it's rarely 90 days, okay? And when a vendor specifies to you, conversely, that you need to make payment in 45 days, it's rarely 45 days, okay? You're either doing it much in advance, much later, you're pushing, you're making deals, and so on and so forth, okay? So, you know, I want to highlight here an example of receivables that we've done. So in this financial model, we have sales in January of 116,000, okay? Now, we can say that we're collecting in 90 days, which is the running assumption here, but the more detailed way to do it is to say, how much of this 116 am I forecasted to collect next month, the month after that, and the month after that? And in this particular example, we're collecting 1/3 of our payments every subsequent month. Now I can change these. I can say, you know, I'm collecting 50% next month, 10% the month after that, and 40% in month 3, because that's the deal that I've made with this particular customer. And when you change these figures, when you change how much you're collecting every month, you're getting a much better handle on your cash flows. Okay? So this is kind of like, how do I forecast my receivables based on my forecasted sales? Okay, so it's kind of like forecasting a forecast. Okay, and please stop me if I'm going too fast or if I'm being confusing. So again, I'm forecasting my sales, and then I'm forecasting how I'm collecting these sales. So it's kind of like a double forecast. Now, the thing that people forget to do most of the time is to take their ending balance or their beginning balance of the receivables from last month, right? So don't forget that we're starting this model from a place in time that actually existed and that actually has data points. So last month I sold for 200,000 JDs and I have an outstanding receivables balance of 650,000. So today I have عندي 650,000 dinar that I need to collect from my customers. How am I collecting this? So after I forecast my sales and my receivables, I have to forecast my collections, which is this number right here. The 650 right here is the number on my balance sheet, which is accounts receivables, 650,000. And I'm going to sit with my collections team or my finance team. I'm going to say, listen, hit the phones, call these customers, and ask them when they're going to pay us. And this is the schedule that we've come up with. We said, this month we're going to be collecting 100,000, 200,000 next month, and so on and so forth. These numbers add up to 650,000. This helps me forecast my cash. And then I go and I do this for other aspects of the business. So my payables. So when we sit with our finance team on the 15th of the month or the 16th of the month, they're going to tell us, look, we have 180,000 in unpaid bills. You know, this is a number on my balance sheet. When I'm doing my forecasting, I have more costs. So these are costs into the future, which will produce payables in the future. But I need to figure out how I'm going to pay this 180,000 now, you know. And if I don't do this, I'm never forecasting my my cash flows in a correct way. Even if I do the right kind of base payables, receivables, if I'm not forecasting the current balance that's sitting on my balance sheet, I'm never going to get it right. Any questions here? I know that this might be a bit of a complex topic. If anybody has a question here, please feel free. Okay, so moving on to some more nuanced, let's say, aspects of this. And Salwa, this might look familiar to you, but it's very important that I do my revenue recognition correctly. Okay, a lot of you guys that sell subscriptions in advance or have tuition payments, so you kind of receive payment before the service is delivered. I'm sure you struggle a lot, or you talk a lot about your cash flow conversion cycles and your revenue recognition. And it is so important that we run by a schedule that looks like this in order to recognize revenues correctly. If you guys have cash flow cycles that are not regular, so if not a cash business, or you have unearned revenues on your balance sheet, or you have prepaid expenses, I highly urge you to build a working capital model that looks just like this, so that forecasts your kind of expenses and revenues on a monthly basis, and then it translates that forecast into a balance sheet forecast that does it on a monthly basis too. So, for example, this company here receives this might be tuitions, let's say. So it receives 280,000 in tuitions in March, but it delivers the education or the training over 12 months. Okay. So the way we recognize revenue is, you know, by the same virtue that we're delivering the service. So since we're delivering our courses on a monthly basis over 12 months, we recognize, you know, 8.3% of it on a monthly basis. So that's, you know, 100 divided by 12. And then that enables me to recognize cash flow in a proper way. So I'm receiving 280,000 in cash, but I'm only recording 23,000 on my revenues. And, you know, this is super critical. You don't want to be forecasting revenues that are based on cash and cash based on revenues. You want to be doing revenues correctly and cash flows correctly, because your metrics look all wonky and you will never be able to manage your cash flows in a proper way. Do this. So, you know, once I do this for all my markets, then we can go and say, okay, what's the summary? What's the bigger picture like? You know, what are my total website users? You know, what's my cash figure there? You know, then we can get into the fun stuff of analyzing the business and making decisions based on it. But to do that, you have to kind of, you know, go through the process of kind of doing things in the proper way and inputting the numbers where they need to be inputted. Any questions here? Anyone want to share? I mean, do any of you do this? I mean, you know, does anybody here run a monthly model that's done on a balance sheet level and an income statement level? And you know, if so, would you like to share how you guys do it? Any challenges that you face with your management teams while you're trying to run this?
I'll chime in again. We don't do a balance sheet actually, and you brought it to my attention, but that maybe we should. I'm not sure, but we have one type of client, and the cycles, the payment cycles are the same every year. So we do focus very much on the income statement, but we do it weekly, monthly, and we do it very, very often. So we keep track of budget versus actual very closely. But with regards to the balance sheet projections, should we do it even if it's more or less the same year to year, month to month?
Yeah, look, I think it's important to have that framework there, Salwa. To start with, I think it's best practice. I think where you'll see this becoming an issue is when you're spending on capital expenditures from cash that's being generated from the business. So if you're not using investor money every time you want to grow into a new market, in other words, if you're taking some of your cash flows from operations and deploying them for investing activities, then you really want to manage your cash flow cycles very well. So imagine in your business, you have a cohort that starts in September, and you get all your money up front, okay? And then in October, you begin spending on your growth mission in Africa. Okay, and you just basically take all the tuition fees that you've collected and your registration fees, and then you throw them in Africa to grow in Kenya, for example. And then in December, you realize that you've basically spent the money that you had for the entire semester in October. So now you're sitting there thinking, okay, how am I going to pay my teachers? How am I going to pay my overheads and my admin? And in general, if you're not using cash flows from operations to grow, then I think you're never going to run into a problem as such as kind of working capital would prohibit you from doing things the right way. But I think if you're taking on any debt or if you have any significant capex, then I highly recommend this method. The other thing is if you want to do kind of segmental analysis, so where you're spending your money and where your cash flows are kind of being spent and being made in different jurisdictions, then this approach would really work. But look, and I promise I'll stop talking after this point. It's just that now that you have the time and you don't have a problem with it, build it. You don't want to build this when you're running into a brick wall or when you're like facing a massive difficulty. You want to have this there because it's a fantastic diagnosis tool. And if your finance team is currently in a good rhythm, then it's definitely the best time to build these tools.
Okay.
I have a situation that I ran into recently. We've closed 2019, and our auditors on some of our programs for maternity and delivery, they said that we cannot claim certain programs that we sold as income for the year 2019 because the service was not completed until 2020, early 2020, which made a big disturbance in our forecasted 2019 financials. So any new program right now we're doing, we are already, what we do is we set it up ahead of time that this is going to be delivered over a certain period of time, and it's included in our financial model to monitor our cash flow adjustments accordingly.
Excellent. Thanks for sharing that, Rashid. I just want to say something here, which I think.
But it was embarrassing in front of my board of directors, actually.
It's okay. We learn from these embarrassments, don't we? So look, I just want to share something here with everybody. Now, if I'm doing this monthly model just once, it might guide one or two discussions. But if I'm updating this on a monthly basis, that's where I'm going to see the most significant value. Okay, and I'm not saying that everybody should do a monthly model and update it on the 16th of any. Different companies have different contexts. And, sometimes this is done on a quarterly basis, semi-annual sometimes. But I think it is important to do this. And what you have to imagine here is if I'm forecasting January, when I hit February, I'm going to have actual numbers for January, and then my forecasting period begins in February, and so on and so forth. And it might sound like such a daunting task, and my God, who's gonna run this? But and again, I go back to the idea of having a dedicated person for this. The person who's in charge of this will kind of live and breathe this, and his or her role will center around this, and they will become a very important figure in the company. And if you're that person, I urge you to kind of take up that role and have somebody with you actually shadowing you to do this. But really, I can't emphasize this enough. Having a monthly process where you kind of update your actuals and then schedule your balances or schedule your receivables and your payables with your vendors and your customers, and then reforecast your sales and kind of the accompanying assumptions there with your P&L and your balance sheet. I think that is the only sure way to do your financial governance without missing anything and without any blind spots in the long run. So I just want to take you guys now to some charts. So again, making things look pretty is very important. If we look at this table here, it doesn't tell us as much as if we look at it here. This is the same data represented in graphical format. The point that I'm trying to make here is anytime you can have a graph, have a graph. It's not just because investors think it looks pretty or because it fills slides. It's just easier to read. When you're reporting to your CEOs and your chief strategy officers, they're parsing through hundreds of thousands of data points on a monthly basis. And so representing something in graphical format is I think it'll be appreciated by your teams, and I think you'll be able to gain a lot of insight. And in my very in my humble experience, investors like it as well. They're more likely to be let's say acquiescent with you. Always try to break down your admin costs. Okay, again, I'm just giving some pointers here before. I mean, we have about 15 minutes left. So what I like to do with graphical data here is when I'm looking at my overheads, I like to see how they're changing in time as a proportion of my entire cost structure. Okay, for most of you guys, you would have let's say salaries and wages would represent the biggest chunk of your admin costs or your overheads, and seeing how those change over time versus other costs like technology costs, for example, would be super important. For sales and marketing or selling and distribution, I would always look at it as a percentage of sales, but also as a budget. So is my yearly budget growing relative to my sales in a funky way, or is it kind of linear? With my profitability margins, again, I cannot emphasize this enough. Even for the highest tech businesses, try to look at your profitability margins. I mean, even if you've never had a month of profitability, try to see how unprofitable you've been relative to your sales. Always, always, always. If your margins are declining, there's a lot of insight there. If they're growing, there's a lot of insight there. It might be an industry thing. It might be a consolidation thing. It might be a pricing pressure thing. Or you might be, not pricing your products properly. It might be as simple as that. It might be as simple as, look, we can price this better. We're underpricing here. So always keep an eye out on your margins. Fixed assets, again, maybe not so relevant here, but I like to, for the traditional business that I've worked with, I like to see what we're spending on. If we have a lot of land, for example, are we using our capital in a proper way? Should I be selling this land? Should I be leasing it? Should I be spending so much on building improvements or not? And finally, just have it all in one place. We like to always have it. In our Excel modeling, at least at Sequence, we always have a tab that's called Report. And what this does is it makes my life easier when I'm building presentations. So this table here that you guys see is basically connected to all the other input sheets that I've shared with you. And it's always representing the outputs in one place. So the next time I have a presentation with an investor or a bank, I can just come in here and say, oh, okay, I want to show them my user growth. I can just paste that into my presentation. I want to show them how my operating expenses have grown or are going to grow in the next 4 years, so on and so forth. So have everything in one place, and then pick and choose based on who you're speaking to. Just to make sure that we haven't missed anything, always use the right tools, know who you're speaking to, and have your reporting be consistent and periodic as always. If I'm navigating an Excel sheet that is not linked, that is full of hard codes and shortcuts, it's not going to be useful. You're likely going to be redoing it in the next couple of weeks. And again, always try to use the 3-statement approach. So income statement, balance sheet, cash flow statement. Those are the 3 statements that you need to look at. If there's something you don't understand in your cash, go to your cash flow statement. If your cash statement is not making sense, check out your balance sheet. Am I having massive spikes in my working capital? Am I spending too much on CapEx? And then finally, look at your income statement. I know that that's where we start, but I personally like to start with the cash flow statement. So again, I'll stop here and I'll open it up to questions. We have about 10 minutes remaining. So if anybody likes to comment, to share, to ask anything, I'll be happy to answer.
Hi Hamid.
Hi Firas.
كيف حالك? First of all, my name is Firas. I'm from Aeon Dental. We are a mass manufacturer for dental custom-made products, mainly clear aligners. Hamid, I wanted to ask about the cash flow. Do you think it's better to use a direct method, especially if you're dealing with management that's not very familiar with how to read financial statements and how to connect things together? Do you think using a direct method would make sense or no, especially that the headache that comes with using it is a bit more, yani?
Yeah, that's a very good question, Firas. Thank you so much. And I know you and I have spoken about this in the past. Just for everybody's reference, the direct method is where you say inflows of X this month and outflows of Y, and obviously with more detail. So we can say I'm receiving 10,000 from this customer, this other customer is paying me, and I have to pay my loans, and I have an interest payment, and I have to pay for my cost of goods sold. That's my ending cash balance. So that's a direct method. The indirect method is where you have the income statement, balance sheet, and cash flow statement. Okay, and the indirect method includes non-cash items in your reporting as well as cash items. Okay, so to directly answer your question for us, I like the indirect method. I mean, I'm always going to be the guy saying, I'm receiving this much from a customer, but that's just cash. How much of it is revenues? How much of it is revenues from last month? How much of it is revenues from a future month that they're just prepaying? What does that tell me in terms of my margins? What does that tell me in terms of my forecast? So with the direct method, I think it has its benefits, and I certainly use it, by the way. So, I advocate the use of both, and I say, do your direct method, show it to your, managers, tell them how much money you're going to require by the end of the month or how much surplus you're going to have. But I don't think doing financial planning based on a direct method is very, very tricky, super tricky. You can't have insights in your direct method on your margins, for example. So in most of my inflow line in a direct method, I don't know how much of that is profit. I don't know how much of that is just break-even. And I can really overspend or underspend if I'm just using direct cash flow method. Now I know that, in an ideal world, we'll all have a financial model that looks like the one I've been sharing with you. So that looks like this, and it has it has a combination of my 3 statements, and it tells me my exact cash line at every possible month. But I know that that's not the case for everybody. So, while you build something like this, while you build a monthly indirect method, use your direct method, but just be careful in doing it for 24 months at least. So that would be my mitigant. If you have to use a direct cash flow method, do at least 18 to 24 months of forecasting, because that will capture a lot of your kind of missing kind of links there. But again, I can't advocate it enough. 3 statements is the way to go. So indirect method whenever possible. Firas, do you guys have a monthly model like this, or do you rely on your direct method mostly?
No, we do have a financial model that we update monthly that's similar to what you're showing. But to be honest, we maybe you're a bit familiar, Yani, from before. We use like a mix between, we have an indirect, of course, for reporting and all of that. But we use like a mix because it's important to always look at your, at least AP, AR, and CapEx, especially that we're in manufacturing. So CapEx will show up, like it will use some of the cash that you will be generating.
Absolutely. And can you tell us who usually has a hard time following the monthly model, and who has an easier time with the direct method? Like just as far as departments go, or as personalities in the company.
It depends, but usually, like if you're talking in a department level, they like to see what they have spent on a monthly level, and they would understand it easiest, especially. But it depends on the department, but sometimes they don't have strong financial knowledge, let's say. But in general, for reporting, I think indirect, and I agree with you, of course, that it gives you more information on a higher level. But on a department level, the direct method, sometimes it makes sense. Like I would send them a small part where it shows how much they have generated cash, how much. You need to show both sales and cash, and we have an end revenue as well, so that makes a difference too. In addition, they want to see how much they have spent because they have budgets for spending. So this way it would give them more insight on this part at least.
Absolutely. You know, Firas, in my experience, I think I've had a very similar experience to you, actually. So when I'm speaking to the collections team, for example, I use a direct method. I say, look, this month you've collected 100,000, which is only 70% of your target. You know, I don't talk to them about the overall receivables picture, for example. But then when I'm speaking to the senior management team, I go for the indirect method. I say, look, our days receivables have gone up. That's not good for our cash, but our margins are improving. So, et cetera. You know, so you know, it depends who you're speaking to, but having both is super important.
Agreed.
Okay, do we have any other questions or comments?
It seems that there's an interference. I can hear a broadcast over our conversation.
Really? And anybody else having this problem?
No.
Okay. Anything else anybody wants to add? Any questions? Any comments? Anything you want to share?
Yes, Hamid, we'd like to ask about the accounting. How do we choose the best best accounting method for the company? What يعني how do we book, for example, if we're booking revenue that covers the next, for example, 12 months, do we book it this month, or we divide it over 12? Same applies for any other aspect.
Yeah, sure. Thanks, Lean. That's a good question. First, I want to give a disclaimer that I'm not an accountant, so many of you on this call might have a better answer than I do right here. However, it's largely been my experience that you should always follow IFRS rules. So if you don't have somebody in-house that is a very kind of qualified individual to help you with booking accounting, I highly recommend that you get one. And I highly recommend that you sit with an auditor or an auditing firm, preferably an auditing firm with a good reputation and kind of no spots in their track record. And that auditing firm should really tell you and should really draw a map of kind of practices of how to recognize revenue, recognize cost, how to report these things, and to generally adhere to IFRS rules. It is super important that you adhere to IFRS rules on revenue recognition and cost recognition, because ultimately this is how your investors would look at things, and this is how your auditing firm would look at things. And it just gives you kind of a benchmark of how to do things properly. So I don't think there should be much debate on this aspect. I'm sure through the Endeavor network, you can have an intro to an esteemed auditing company or auditor at least. That would help you with that. Okay, I think we're just hitting the noon mark, so we would have to wrap it up at the moment. Sama, if you'd like to.
If you have any other individual questions or anything more specific, please don't hesitate to reach out to either Hamid or myself. If you want to set up a meeting as well, so we can look over your financials, to look over your model, if you need any kind of assistance with creating a new model or updating yours to be more flexible according to what Hamid taught you today, let us know. Also reach out. You all have my email, I think. It's sama.yaish@endeavor.org. And yeah, thank you all for coming.
Yeah, and just thank you. And just a final remark. If you guys have any problems with forecasting, or if you feel like you're not really doing things in the way that you'd like to do, we'll throw the challenge at you. Try to build a model like this, or try to build any model that's super simple. I'll be happy to take a look. I'll be happy to help you guys out. Anything you need, please reach out to Sama. Thank you so much for taking time out of your day to listen in, and thanks for sharing your experiences. And I hope to hear from you soon.
Thank you so much.
Thank you, Hamid.
Thank you.
Thank you so much.
Thank you.